So we're going to use the information for the following cases. So we have the payments on account in October, the sales on account in October, and the cash balance. And so a quarantine company had $152,000 of accounts payable on September the 30th and $132,500 on October the 31st. Total purchases on account during October were $281,000, determining how much cash was paid on account payable for during October. So that'll be the first one that we'll do. So we know then that we have to look at the accounts payable and what's going to happen there. So if we look at in September the 30th, we see that there's a credit on the credit side for $152,000 because that is showing that's how much they owed. So remember that accounts payable is a liability. So in order to increase a liability, you have to, so then it would be a credit in order to increase it. And on September 30th, they had a balance, and then they had another purchase on account during the month of October was $281,000. But they paid at the end of the month, that's what they had was $132,500. So then over the course of the month, they had to have paid $300,500. And let me show you that. So if we look, we know that they started out with $152,000. And then it said that they purchased $281,000. So then that would be $433,000. Now, if you subtract what the ending balance was for the month, that's how you figure out how much they paid. And that's what they're asking us to do. Okay. Now B, and this is a different company. So on September the 30th, Valerian had a $102,500 balance on accounts receivable. During October, the company collected $102,890 from its credit customers. On October the 31st, balance of accounts receivable was $89,000, determining the amount of sales on account that occurred during the month of October. So then we have accounts receivable. And remember that accounts receivable is an asset. So that an asset will increase on the left-hand side, which is the debit side. So we see here that on September the 30th, they had a balance of $102,500. They collected $102,890. So they collected some from the previous month. Now, remember that in order to decrease an asset, you have to credit it. And so the credit it would be on the right-hand side of the T account. And so the balance is this. So then it's a little closer unless I made a mistake there. Okay, so if you take the balance, so we said that they had a balance of $89,000, and then you add what the beginning balance of it was. It's still not right unless there's a mistake. But anyway, you figure out what, because they're trying to figure out what the collections were. So let's skip it. Yeah, so sales on account. Let's see. Okay. And then during October, Alameda Company had $102,500 of cash receipts and $103,105 of cash disbursements. The October 31st cash balance was $18,700. $600 to determine how much cash the company had at the close of business on October the 31st. Okay, pardon, let me get back to that. Okay, so on this one, if we look, same kind of thing. We see that cash is an asset, so it's going to increase on the debit side, decrease on the credit side. And so it said then that they had, as of the end of the month of September, they had $19,250, and they had cash receipts of $102,500. And then minus how much cash they paid out, you're gonna get the balance, which that's what they would have had at the end of the month, would have been $18,600. All right, let's look at another one. Let me go back. So now we're going to start actually journalizing some transactions, okay? So we're going to prepare the general journal entries for the following transactions for a new company called Pose for Pics. A debit, which is again on the left-hand side, and then a decrease with a credit, which is on the right-hand side. And the normal balance for an asset is on the left-hand side, on the debit side. And then liabilities then are just the opposite. So they decrease with a debit, increase with a credit, and the increase is on the right-hand side. And then equity, it's the same kind of thing. So equity decreases with debit, so that would be the owner's withdrawals and expenses, and then increase with a credit, which would be the owner's investment and the revenues. So if we look here to the first one, it says Madison Harris, the owner, invested $6,500 in cash and $33,500 of photography equipment into the company. So we're trying to figure out then what her investment was. So she invested cash. So in order to increase, we're going to have to debit cash in the amount of $6,500. So that's increasing how much cash. And then photography equipment she had was $33,500. So that would be a separate account. So you have cash account, and then you have an account of photography equipment. So again, to increase both of those, they're assets, you have to debit them. And in M. Harris Capital, you're going to credit $40,000. And so you see that. And then on August the 2nd, then the company had to pay $2,100 in cash for an insurance policy that's good for the next 2 years, 24 months. So we see here, August the 2nd, we have to debit prepaid insurance because prepaid insurance is an asset for $2,100. And then cash, we will credit cash for $2,100 because we're paying cash to the insurance company. So we need to decrease the amount of cash that we have. And then on the 5th, the company purchased office supplies for $880 in cash. So we see here that office supplies is an asset that's increasing. That's what we're receiving. So we have to debit office supplies in the amount of $880. We will likewise credit cash in the amount of $880 because we've paid out cash now for the office supplies. And then on the 20th, the company received $3,331 in cash for photography fees earned. So she's now taking pictures. She's now had some sales, and so now she's receiving cash from her customers. So what we would have to do is we would debit cash, the amount of $3,331, because we now need to increase cash to show, what we've received. And then photography fees earned, that's part of our revenue, which is part of our equities. So we would have to credit that $3,331. And then the company paid $675 cash for August utilities. So August 31st, we would have to increase utilities expense, which again is part of equity. So in order to increase that is going to be a debit, $675, and then we paid cash, which will be our credit for $675 because we're reducing cash because we've now paid that out. Let's look at one more. That's similar, but just make sure we kind of understand this. Are we doing good so far with this? Journalizing transactions?
Yes.
Okay. Let's see where we're at here. Hold on, let me go back. Okay. We'll do this again just real quick, just because this is important, and this is where I know students have a lot of trouble. They get confused by it. So again, she's investing. This time she invested $10,700 in cash and $46,300 of photography equipment. So again, we would debit cash because we have to increase that, and also the photography equipment, and then capital. Okay, same thing here with, again, the prepaid insurance, because we're increasing that because that's an asset, $3,800, and then we credit cash because we're paying out cash. And again, office supplies, we're going to have to debit office supplies by $2,400 because we're receiving office supplies. That's an asset. We have to decrease our cash by that amount because we're paying out cash. And then she received money from her customers, so we have to debit cash in order to increase cash, $3,300, and then the photography fees earned, we're going to credit that by $3,300. And then August 31st, you have utilities expense, $600, because you have to recognize the expense on the equity, and then you debit that, and then we paid out cash, so we credit cash $600. Okay. Now again, kind of thinking back again to what we just did. So we're using information below to prepare the trial balance for pose for PICs. So we'll begin with opening these T accounts: cash, office supplies, prepaid insurance, photography equipment, M. Harris Capital, the photography fees earned, and utility expenses. Then post the general journal entries for the T accounts, which will serve as the ledger and prepare the trial balance. So we'll take you through all of that here. So we'll look at this. So again, this is the general journal here. So we have the first one is August the 1st. We have a debit to cash, $6,500, because the company is receiving cash from the owner. And then likewise, again, asset, photography equipment is an asset, and we're receiving photography equipment, $33,500. Now you'll take the total of these for M. Harris Capital. That's part of equity. To increase equity, you have to credit it. So $40,000. One thing too for you to note that's important, and you probably have figured this out already, is notice here that our debits here equal our credits. That's really important. Really easy on these other ones because you see it's going to be the same amount, but this one you have to add them together. Okay, but that's another common thing that I see students, they don't quite understand that concept. So it's important that we get that right off the bat here. So your debits equal your credits, okay? If they don't, then you know that you made a mistake somewhere, either a mathematical mistake or you made a mistake in analyzing the transaction. Okay, so we see here that August the 2nd, you have prepaid insurance. Again, it's an asset, so we'll debit that, $2,100. And in cash up here, we'll credit that $2,100 because we're paying cash out. Office supplies, we'll go ahead and debit that at $880 because we're receiving office supplies. We'll go over here again and credit cash the same amount. And in August the 20th, we received revenue for $3,331. And we'll credit the photography fee earned. And then utilities expense, We will go ahead and debit that, 675, and the cash will go ahead and credit that. Okay, so then we'll have to then figure out then what the balances of these are. But so far, before I do that, so far, anybody has any questions so far?
Yeah, I have a quick question.
Okay.
When you're crediting, you're crediting cash and then you're crediting Harris Capital and the other one. Are those just different accounts, like photography fees earned? Is that you're crediting an account photography fees earned?
Each one of these, yeah, each one of these is an account. So you'll have an account. So for example, for this business, cash is a separate account. Photography fee earned is a separate account. Office supplies is a separate account. Utilities, all of those are separate accounts. And so if you look at, you'll have a chart of accounts that lists that lists out all of your accounts. Okay.
Okay. Thank you.
Now, the one thing that's tricky about this, again, is this is just on paper. You wouldn't have like a separate bank account necessarily for each one of these. So cash, you would have like for example, for cash, you'd have a bank account that's your checking account. You might also have maybe some of that in savings. You might have some of that on hand, maybe that you haven't taken to the bank yet, but all of that would be considered part of cash. Okay. And then all of the, for example, all of the photography equipment, all of her cameras, the lighting, if she has printers that she uses to print the pictures, all of that would be part of her photography equipment, okay, etc. Okay. So to figure out the balance here, then let's do this. So we know that we received 6,500, and then we received 3331. Now, so that's the cash inflow. That's the cash that we received. Then we have to subtract the cash that we paid out. So very much like we do with the checkbook register, we have to keep track of that, which I hope that's what you guys are doing. Even if you use you guys use your card, I hope you guys write all that stuff down, okay? Same kind of concept. So we see here then that for cash, then her ending balance then for the month, what she should have in the bank or cash equivalent, she should have $6,176. And then we can do the same thing then for really easy. We'll just bring it down to photography equipment. We'll just go ahead and carry that balance forward, because now let's say maybe she bought a new camera, and that camera was, I don't know, $1,000. You'd have to list that here, whatever date she had, and then the amount, and then you'd have to add it. But she didn't. She kept the same equipment. Or maybe she had a lens maybe, and the lens got broken or got messed up. She can't use it anymore. She's not going to use it anymore. She'd have to subtract that from her equipment, but she didn't do that. Let's look at, same thing here. So capital, her capital didn't change at this point because we haven't done anything with that. So we'll just go ahead and bring that down. Same thing with office supplies. Now, later on, we'll have to figure out the expense, like what office supplies she used. So for example, maybe she had to send out some bills, and so she used some envelopes, and she used post stamps, she used stuff like that. Well, we'll figure that out later, but that would be, we'd then have to expense how much of the office supplies she actually used. But for right now, we'll just bring it down. We'll talk about that later, probably the next chapter. And then photography fees earned, again, we'll just go ahead and bring that down. Same with prepaid, same thing with utilities. So then, really easy then is, once you figured out everything, then is you can go ahead then and do your trial balance. So this is our pose for pics trial balance. So again, you have the accounts listed here, debit and credit, and then the amounts. So we know that cash, she has a debit of 6,176. That means that she has a positive cash balance. Okay. Again, and so office supplies, she has 880 of office supplies. Insurance, she has 2,100 of insurance. Photography equipment, she has $33,500. Okay, so then we have her capital of $40,000. Again, that's a credit because that's on the other side of the equation. And we see that she had a positive balance there. Her photography fees earned she had was $3,331. And then she had utilities expense of $675. And again, $675, it's going to be a debit because it's an expense. And so total then we see is that we have the assets and the expenses, and then we have the equity section. We see then that everything balances out. So 43,331, 43,331. All right, so now we're going to prepare the general journal entries to record the transactions below for Spade Company by using the following accounts. So we have cash, accounts receivable, office supplies, office equipment, accounts payable, K-Spade capital, K-Spade withdrawals, fees earned, rent expense. And you'll use the letters besides each transaction to identify the entries. After recording the transactions, post them to T accounts, which serve as a general ledger for this assignment. And then we can determine the ending balance for each T account. So the first entry that we have to make is that Casey Spade, owner, invested $100,750 in cash in the company. So I'll let you guys kind of guide me. What would I debit first? Well, we would have to debit cash, right? So debit cash, the amount of $100,750. And again, the reason for that is because cash is an asset, and so it increases with debits, and it's on the normal side. And then we'd have K-Spade capital, and that's an equity. And so in order to increase the owners and show the owner's investment, we will credit that. And so we credit that to increase it. And so again, we have a debit over here for cash, $10,750, and then a credit to K-Spade capital, $100,750. Let's look at one more. So the company purchased office supplies for $1,250 in cash. So we'll debit office supplies, the amount of $1,250. Then what would I do?
And then you credit
cash, okay? Yeah, so office supplies would be debited $1,250, and then cash would be credited the same amount. And if we look at the T accounts again, because office supplies is an asset, to increase an asset, you will debit. So you'll debit that $1,250. And then we're looking at B here. Cash, we have to credit that $1,250 because we're paying cash out. So the company purchased $10,050 of office equipment on account. So they used credit. What would I do here?
debit office equipment.
Okay. And then what would I have to do?
And they paid with credit.
Okay. So we would have to credit accounts payable, right?
Oh.
Because that's a liability. $10,050.
So accounts payables is generally connected to credit.
Yeah, usually we just say, if they say that we paid credit, we'll usually say that we'll just usually use accounts payable, usually.
Okay.
Sometimes you might have separate accounts payable accounts for each one of your vendors. You might see that, but in this case, we're just going to have one account that's for accounts payable.
Okay.
At least for right now, because we don't want to confuse you too much. So we have office equipment, again, debit $10,050, because that's what we received. We received the office equipment, and then we had to pay, and then we paid with accounts payable $10,050. Notice again that accounts payable is a liability. So that's on the other side of the equation. And to increase a liability, we have to credit it. because we still owe this money. We're going to have to pay it off later. Okay. The company received $15,500 cash as fees for service provided to a customer. And so this time what I would have to do is I would have to debit cash because I'm receiving cash from my customer. So cash is an asset. It increases with a debit. So 15,500, and then it was received, it was from revenue. So fees earned is part of our equity because it's part of our revenues. So we have to credit that. So we would credit that 15,500. And again, notice then that it both balances out also. And so we see over here cash, we have a debit of 15,500 because we're receiving cash. Fees earned will have a credit of 15,500 because that was part of our revenue. The company paid $10,050 cash to settle the payable for the office equipment that we purchased in transaction C. So we see then that accounts payable, this time we will have to debit accounts payable, $10,050, because notice that accounts payable, as I said, it's a liability. So to decrease a liability, we debit it, and then to pay cash, they paid cash, same amount, $10,050, because they've now paid out cash. And so cash is an asset. So to reduce an asset, we have to credit it. Okay. So then we see here that accounts payable, we debit accounts payable. So then guess what? Both of these wash out. So right now, our balance for accounts payable is 0. We now don't owe anything to accounts payable. Okay. And in cash then, in order to decrease cash, we will credit $10,050 because we now have less cash to us. Because again, decrease an asset, we have to credit. The company billed a customer $2,700 as fees for services provided. So this time, the company sent out bills to their customers. So this time, we have to debit accounts receivable. Remember, we said accounts receivable is an asset. So in order to increase an asset, we have to debit it. So we'll debit that $2,700. And then we will credit fees earned because that's part of our equity section. And so to increase and revenues, so to increase our revenues and therefore the equity, we have to credit that. So then we have accounts receivable, debit of $2,700. So we have fees earned as a credit, $2,700. And then the company paid $1,225 cash for monthly rent. So then our rent expense, we have to debit that $1,225. So again, that's part of our equity and that's an expense. So in order to do that, we would debit it in order to decrease our equity, $1,225. And then we paid out cash, $1,225. And so in order to decrease cash, we have to credit cash. So we see here that our rent expense is debited for $1,225. And then cash is credited $1,225 in order to reduce cash. The company collected $1,125 cash as partial payment of account for the accounts receivable that we talked about in transaction F. So we see here then that cash would be debited $1,125 because we're adding cash. Again, cash is an asset, increases with a debit. And then our accounts receivable now, likewise, is an asset, but now we don't have as much accounts receivable now because we've now received some of our money that we were owed. So we have to credit that then 1,125. So we see then that cash, we debit cash 1,125, and we will now credit accounts receivable 1,125 now in order to reduce the accounts receivable. And in Casey Spade withdrew $10,000 cash from the company for personal use. So Kate Spade withdrawals, debit $10,000 again, because that Kate Spade withdrawals is part of equity. So we have to debit that, and then credit to cash 10,000 because we have to reduce the cash that we have because we're paying cash. So we see here Kate Spade withdrawals is $10,000 debit, and then cash credit $10,000 because we have to reduce the cash. So then we see here the different ones. So I'll help you. We'll go through here and we'll add up the balances. So cash, we had credits. So we had our initial. Okay. And then we have to, so that was what we had paid in, was $117,375, and then we paid out cash for various things. Okay. So then our balance then would be $94,850. So the normal side for an asset is a debit, and we're positive in cash, so it would be a debit side, so $94,850. And if we look at capital, we can just go ahead and bring that down because that hasn't changed so far. Now later on, we would have to recognize the net income there and some other things, but for right now, we'll just bring it down. Office supplies, we'll just go ahead and bring that down, $1,250. Again, normally we would have to make some adjusting entries to that, but we'll talk about that later. So office equipment, same thing, that hasn't changed. And again, it's a debit because it's an asset. So cash is an asset, office supplies is an asset, office equipment is an asset, cash receivable is an asset. Again, and then Kate Spade capital is part of owner's equity. Accounts payable is a liability. There wouldn't be a balance here, as I said, because we've paid it off completely. And then fees earned would be $18,200 again. Since this is part of our equity, so we credit in order to increase our equity. And then our accounts receivable, we have $2,700. That's what we billed for. So debit, and then we received 1,125. So then we still are owed as a business 1,575. Debit, again, that's an asset. Rent expense, we'll just carry that down. Again, that is part of equity, but it's an expense. And so we debit that. And then again, the withdrawals, again, that's part of equity, but in order to, because that helps to reduce the capital because she took out money from her business. So after recording the transactions in exercise 2.9 and T accounts and calculating a balance for each account, we'll prepare the trial balance. We'll use May the 31st of 2017 as the report date. We're going to take the information that we just did, squeaky chair. So we have the Spade Company, trial balance, and then again, the date was for the month ending May 31st of 2017. So again, you have the account title and then debit credit. So first we'll list our assets. So we have cash, and then we had $94,850 in cash. And what I'll do here, I don't know, be a problem. I'm just going to go ahead and ink, but that may be a problem. So we did cash. Then the accounts receivable we have is $1,575 because that's what we're still owed. Then we have office supplies, $1,250. Office equipment in the amount of $10,050. Accounts payable. So now we're going to start doing our liabilities. So we have accounts payable, which is 0. So we don't have that. You could leave it blank or you could put 0 in here. Kate Spade capital is $100,750 because, again, capital that's on the other side of the equation, so it normally has a credit balance. Kate Spade withdrawals, $10,000 because that's how much she took out. So in order to reduce her capital, then we have to use a debit, and so that would be there. And then fees earned is $18,200, and that would be a credit because that is increasing our equity. And so to increase equity, remember, you have to credit. And then rent expense is $1,225. And so for that, we have to debit that because that would decrease our equity. And so then we just go ahead and add up both of these columns, and we come out with $118,950. And so then we see that each side balances. We know that everything should be correct. So now we're going to learn about how to figure out our net income. So now sole proprietorship had the following assets and liabilities at the beginning and end of the year. Determine net income and loss for the business using the following cases. So first of all, if at the beginning of the equity year we had $40,000, we'll go ahead and say that for each one. And then at the end of the equity year, we'll say that they had $69,000. So we see here that the investments by owner, the first one, they didn't have any investments by owner and they didn't withdraw. So then what we could do is we just take the ending year equity is $69,000 and just subtract where they were at the beginning of the year. That gets that they had $29,000 income. So you just take, because obviously they ended the year higher than they started, and they didn't add anything or take anything out. So the next one, B here, it says the owner made no investments in the business but withdrew $1,250 of cash each month for personal use. So he withdrew $15,000. And so then if we look, we see then that they had $69,000 start out with, okay, plus the 40. That's not right. Minus the 40, okay, plus the 15. Yeah, so let me show you again. So on that one, you'd take the ending, which is the 69,000. You'd have to minus the beginning, which is 29, plus how much they took out, the owner took out. So then you have net income of 44,000. And then on number C, it says owner made no withdrawals during the year, but the owner did invest an additional $55,000. Okay. So then we have 40,000 plus the investments by owner is 95. So they had a net loss of 26,000 because they ended the year here, but they didn't. He began the year here, and then he had to add more. So they should have ended the year a lot higher. Now the owner withdrew $1,250 in cash for personal use, and the owner invested an additional $35,000. Okay, minus what he took out. Okay, plus what he added in. There we go. And then minus where he ended. So he had a net income of $9,000. Carmen Camry operates a consulting firm called Help Today, which began operations on August the 1st. On August 31st, the company's records show the following accounts and amounts for the month of August. Use this information to prepare the August income statement for the business. The owner invested $102,000 in cash to the company. So then we'd have to set up, we have revenues, expenses, and net income. So note that they list assets are reported on the balance sheet, but not on the income statement. So there's some of these things here that we don't need. Okay, so we'll go ahead and get rid of what we don't need. And then liabilities are also reported on the balance sheet. So we'll get rid of the liabilities. Okay, so beginning capital is reported on the statement of owner's equity. Withdrawals are also reported on the statement of owner's equity. All right. So then we have our revenues. So we have consulting fees expense of $27,000. So we'll list that under our revenues. And then we list our expenses. So we had rent expense of $9,550. We have salary expense of $5,600. And then we have telephone expense of $860. Miscellaneous expense of $520. So then we have to add up our total expenses, $16,530. So you're going to put revenues over here on this side because that's a total. So the total for the revenue. And then you list out your expenses here. And then we add up our expenses, so $16,530. So then if we subtract each of those, you get $10,470. So they had a net income, or another way of saying that is the net profit of $10,470. And so the next one we'll do is the statement of owner's equity then. So we have C Camry Capital. So we see that we have to add the investment by owner and then the net income. So the investment by owner, we said, was $102,000. So we'll add that, and again, it goes over here on the right-hand side because that's a total. And then we have the withdrawals by owner of $6,000. It said that Carmen took out. Then we're going to get either the net income or the net loss. We're going to get that from the income statement. So if we go over here and we look at our income statement, and again, we see here in yellow the things that would be included there. We get that we had a net income of $10,470. So then that would go right here, net income. So that's just a total 112,470. So then we get that Camry capital for August 31st was 106,470. She had barely started her business. So in July 31st, it was zero. Business didn't exist, but she added 102,000 because that was her investment. And then for that month, she had net income of 10,470. That's how we get this. So 112,470. Then we have it said that she withdrew $6,000 that month. So if we subtract 6,000 from that, you get then that her ending capital was 106,470.
Okay.
Carmen Camry operates a consulting firm called Help Today, which began operations on August the 1st. On August 31st, the company's records show the following accounts and amounts for the month of August. Use this information to prepare an August 31st balance sheet for the business. The owner invested $102,000 cash in the company on August the 1st. So we see here a balance sheet, Help Today balance sheet. So again, on the left-hand side, you're going to have assets, and then on the right-hand side, you're going to have total liabilities and equity. So assets. So these are our assets: cash, accounts receivable, office supplies, land, and office equipment. So we would just go ahead and list those. And then we would have and then we get a total, 116,970. Then we have our liabilities. And so the only liability it looks like we have right now is accounts payable. So we'll list that: accounts payable, 10,500. Then we have the owner's equity. So we have Camry capital of 10,000. Camry capital of 106,470. We get that from the statement of equity that we looked at earlier. And then we see here then that everything then should balance. So we see 116,970, 116,970, we know we're in balance. And then we see here, so again, the net income from the income statement of 10,470 gets reported over here under net income on the balance sheet, on the statement of owner's equity for 10,470. So then we can go ahead and add that up. So we see that, then that's the balance sheet then that we should have. Compute the missing amount for each of the following separate companies. This, you just kind of got to work backwards and think again what's happening. So if we look at CBS, we see that they didn't have any equity at the beginning of the year. They had a beginning investment of 110,000 plus the net income. Is 132. Then we want to know, okay, we know that they ended the year at 104,000. So then we know then that the withdrawals by the owner have to be $28,000. And again, in accounting, we know that a negative number or a withdrawal is listed in parentheses. So let's look at